Welcome to the Node, your place for both TradFi and DeFi, crypto news, interviews, and education. I am Mike, aka Veteran Crypto, and with me, as always, is David from DeFi University. How's it going, brother?
Outstanding, Mike. I saw the news today that our dear leader in North Korea, the Democratic People's Republic of North Korea, he got reelected today, man. So that's good
Oh,
news.
congratulations to him.
Yeah.
I'm sure it was a free and fair election. They
Well,
got me to show ID.
so he only got 99.38% of the vote.
Oh,
You
so
know.
so what? That would be what, like 0.52?
Well, I mean, so how exactly, if you're going to the polls in North Korea, like,
Oh, 0.62.
you
Point
know,
six two of people are getting executed.
right? Don't do that.
Yeah. No,
Yeah.
it's an interesting place. Actually, that was my first duty station was South Korea, obviously. Back in 1993, and I was stationed on the DMZ, and so we were. I got very knowledgeable about the politics and kind of the economics and all of that stuff between North and South Korea because it was pretty much on a monthly basis. There was they would threaten to come across the border and we'd get alerted and the middle of the night, you're like hungover, you're still drunk half the time from the night before, and sirens go off and you run down in your underwear to the arms room, grab your weapon, run out to get in your foxhole, and you wait to see if it's a real thing or just a fake thing. And so yeah, it's an interesting place.
Now, here's a question for you. Do you think that in North Korea, you've got to show ID to vote?
Honestly, I would say no, because I'm sure that there isn't actual voting. It's basically already determined. Because
I don't know, man.
what is it, 3 generations now? Because when I was there, I'm wanting to say it was the grandfather of the guy now. It was like Kim Il Sung, and then it was his son, and then now this guy, and then supposedly next in line is supposed to be his sister, because I think there was rumors that she was trying to overthrow him, somewhat recently.
And so check it out, dude. Yes, you do. In North Korea, you're required to present your resident registration card or official ID to verify your identity before you can cast your ballot. But you
I
can
would
only,
like if
yeah,
anyone even showed up to vote, unless they're just scared of if they don't, of what happens if they don't.
it's kind of funny.
It's just funny that I mean, it goes to show you, freaking, elections are kind of, theater everywhere. But anyway, let's jump into this. So let's pop you up here. So if you aren't already and you want to join the conversation, join the chat, ask questions, make comments, make fun of us, whatever you want to do. Come on over here to the at the node_ channel. It's our YouTube channel, and it's where you can chat. If you would like, you can come on over here to our official Twitter or X account at the node channel, no underscore. You can see we're live down here. David's drinking his coffee.
Mm-hmm.
And you can see we're live down here. David's drinking his coffee.
Mm-hmm.
And I gotta mute this. I'm hearing myself. It's no bueno. All right, here we go. And then finally, we got the website that David's been hard at work on, our official website, thenode.pro. And you can see over here on the left, all of these links under research links. Every morning before we go live, all the different topics that we're going to be talking about. I post links to, basically where I got the information from. So, if you want to read deeper, if you don't believe what we're saying, you can go in and you can do your own research. We are huge on don't trust us, don't trust anybody. We're going to give out the information we find, but it's on you to do your own research. And what you do with that information is 100% on you. We're not financial advisors. This is not financial advice. We're just sharing how we do our research and what we do to decide how we're going to invest and what we're going to do. So just want to make sure that we stress that. There's also a bunch of stuff you don't have to pay for on here. We can't say the F word. So uh, you have courses so you can access DeFi University, all of which there's no catch, there's no hitch. You can go there, go through all the courses, take all the quizzes, and it costs you nothing. Our community, you can join the Discord. We have a great group of people in our Discord that are happy to help anybody with questions. We post news in there. We talk about gaming and life, homesteading, firearms, whatever. It's just a place that you can hang out with like-minded people. Really cool. David offers coaching, one-on-one coaching, if you want to accelerate your education. If you want him to go over your portfolio and one-on-one on a live call, he works with people, individuals. Doesn't have to be high net worth, but usually it's people with a high net worth that want to invest a decent amount of money, like a 5, 6, 7 figure portfolio. But anybody can do it. The newsletter. This is something we're very proud of. So myself and DeFi Don got together. I built the UI, the user interface. He did all the data integration, and then David integrated it into the site and into our cloud server. But it's really cool because it is fully customizable. So I don't pick in the mornings what I'm doing now until this is done. I don't pick the assets that are in the newsletter. You do. So you go through and you pick whatever tickers that you're invested in or thinking about investing in. You generate the newsletter. It generates the news articles based on what you choose. It chooses the trading ranges. It chooses the liquidity pool ranges. The whole newsletter is customized to the assets that you choose. So it's, as far as I know, it's the only newsletter out there of its kind. So by all means, please feel free to join us at thenode.pro. And we also got a store that we're standing up. And so if you just want to, represent, if you're a fan or just you like the way that the swag looks, we're going to have hoodies and hats and all kinds of stuff. Me and DeFi Don are working on that right now. Just got to get all that set up. So with that being said, David, let's jump into the news. So we're going to let's start with the macro. So it looks like the FOMC meeting concludes today at 2 o'clock Eastern time. So as soon as this show ends, so it looks like that they're going with a hawkish hold. Wall Street is pricing in a 98.9% certainty that rates remain steady at 3.5% to 3.75%. However, the focus is on the dot plot projections as geographical tensions have effectively killed hopes of an early 2026 rate cut. So can you explain to everybody what a hawkish hold is, David?
Yeah, sure. So it just basically means, higher for longer and higher rates for a longer period of time. So here, let me go ahead and share my screen so that I can share a little bit about FedWatch. So FedWatch is this tool over here on the CME Group's website. And this tool allows you to, essentially, what's that, Mike?
Are you able to zoom in a little bit? Sorry to interrupt.
Yeah, let me see here. So that's 125%. So usually when you hop onto this, you're going to see the next FOMC meeting, which is actually today, in 1 hour and 50 minutes. So this meeting, the expectation is that rates will be kept, steady at 350 to 375 basis points. So this is the Fed funds rate. Now, notice there's actually a 1% chance now of a rate hike. So that is really, really interesting that not only are we, not pricing in any probability of a rate cut to 325 basis points, but there's actually a 1% chance of a hike. So, that whole idea of higher for longer certainly makes sense to me. That's referred to as a hawkish hold. You see, the market wants to see rate cuts, but everything that's been going on, recently in the Middle East, and the fact that oil has shot higher, rocketed higher, as we can see right here on this chart of crude oil. Look, energy is an input cost for everything. And as rates have pushed higher along with crude oil, that makes it very, very difficult for the Fed to come in and start cutting again. Because if inflation expectations are pushing higher, then you're not going to get rate cuts. In fact, you're going to get rate hikes. And so that dot plot, Mike,
Yeah.
that you were referencing, this is that dot plot. So the dot plot is simply, FOMC market participants. So these are the Federal Open Market Committee. These are I think it's like 12 governors that vote. And so every one of these dots represents the forward-looking interest rate expectations for each of those FOMC voting members. I think they're
Oh,
referred to as
so
governors.
each dot is one of the members of like the council or the whatever. Yeah,
Yeah, the royal presidential decree, whatever.
the royal they.
Yeah, the governors of the royal body of, fucking the Fed or whatever. But yeah, these people, they vote based on what they think interest rates should be moving forward. And so you can see that this dot plot is referred to as goes all the way out into 2028, which it's just the more you understand this stuff, man, the more ridiculous it is, because these guys use ancient data and then they don't make any movement until their old stale data tells them, hey, it's time for us to do something because we're behind the eight ball.
So
And so like,
they're reactive. They're not proactive.
yeah, and so like the whole idea that they could even project out, 2 years into the future
It's
is like
ridiculous.
kind of ridiculous,
Yeah.
But these are the expectations. The expectation is for lower rates. So you see the median is in blue. And so the expectation is over the next several years that rates actually move lower. And so the target rate is just above 3%. So
Okay.
this is usually measured in basis points. So you would say it's roughly 300 basis points is the quote unquote terminal rate. That's what it's referred to as, the terminal rate.
Okay.
So, you get this dot plot based on the FOMC governors, their expectations.
Awesome. All right. Well, next up in the macro, we got energy and security pivot. So uranium has officially transitioned into a quote end quote or quote national security asset end quote as supply deficits loom. Global nuclear capacity is projected to hit 992 GWE, a gigawatt something, by 2050, driving massive institutional interest into Canadian uranium basins to offset reliance on foreign suppliers. So, are you seeing or tracking anything as far as investment when it comes to uranium?
Yeah, I was just reading about the Department of Energy investing $2.7 billion to jumpstart domestic uranium enrichment.
Mhm.
Um, and it looks like Russia provides between 20 and 40% of the world's enriched uranium and holds I guess, a near monopoly on something called HALEU. HALEU is high assay, low enriched uranium, which is required for next generation, those small modular reactors that everyone's always talking about.
Oh, okay. No, those things look interesting because I mean
Super.
they're supposed to be like able to make them small enough to like power a single home. So basically, you wouldn't have to worry about a power grid or like the power going out, things like that. So yeah, I'm super fucking interested in that.
Yeah, so they're trying to say that uranium could be the AI fuel. And I love that. I think that that's like brilliant.
Yeah.
Did you know that Bill Gates has a company called TerraPower?
No.
And so TerraPower is his company that they're trying to wean off of Russian fuel. I wonder how many fake meat burgers TerraPower could make. you know,
Well,
uh,
looking at that stock, and they're not selling too many of those freaking, freaking fake meat or I forget what it's called.
oh yeah, that stuff it's basically soy. You know,
Well, and
Like,
it's disgusting looking, like the 3D printed steaks. It looks like a. You remember those old Play-Doh? Like
oh
a.
yeah, dude.
It,
Yeah.
it looks like it's 3D
Yeah.
printed Play-Doh. It's
Can you imagine eating that shit?
not
Ugh,
a fucking chance, dude.
no way.
Not
Gross, man.
a fucking chance.
Not a chance, man. And they were trying to sell that stuff for more than the real thing at, like, Burger King or whatever. Probably
Yeah,
part of the reason why they went out of business, right?
yeah.
Yeah. But
No, it's
they're trying to say that uranium is going to be the AI fuel though. Because all these companies like Microsoft and Google and Amazon, they're signing these long-term power agreements tied to nuclear plants. And so this stuff is really long-term. It takes years and years to start to, build these things. And it looks like, prices for uranium are pushing higher. So I'm not quite sure how it's measured. It looks like it might be measured per pound. So spot prices for uranium, what I see is above $90 a pound, which I don't know where you would exactly, buy uranium like this.
somebody's sitting there with like scooping it into a scale, and it's like you're buying cocaine or something.
Yeah, man. You got a triple beam scare that you're using to buy some
Yeah,
uranium.
exactly.
Yeah,
Like some guy with a trench coat.
yeah.
All right. Well, in TradFi, the S&P 500 goes 24/7 in a historic bridge between TradFi and DeFi. S&P Dow Jones Indices has officially licensed the S&P 500 to trade XYZ. This allows the first ever officially licensed perpetual derivative of the index, trading 24/7 on the Hyperliquid network. What are you seeing on this, David?
Yeah, well, I mean, look, Hyperliquid is one of the highest quality digital asset tokens out there, the Hype token. And
Yeah.
Hyperliquid also, outside of Tether and Circle with their USDT and USDC stablecoin products, Hyperliquid is the most profitable DeFi protocol, period. So it is a very, very successful protocol. And the S&P 500 perpetual futures contract, which is a derivative contract with no expiration date, and you can also trade that with leverage. That is, now traded on Hyperliquid 24/7, and this is, institutional grade index data that's being fed into that contract from the S&P, Dow Jones. I think that's the company that owns the S&P, maybe. But yeah, so the platform Hyperliquid is a very, very fast, optimized chain, and
Mhm.
it's just a really fast decentralized order book. So now that we're seeing, the expansion of traditional markets onto digital rails, starting with these perpetual futures contracts, we're probably going to see an explosion in trading volume. And you'll probably end up seeing more and more trading volume come on chain onto Hyperliquid. And Hyperliquid's Hype token, actually pushed above $40. Um, so if I just take a look at Hype real quick, I think it might be giving some of it back, but here's Hype. So Hype, breaking out above $40. And hey, you know what? Now that Hype is well above its 200-day moving average, broke above trend line resistance, and seems to be pushing higher, the next level of resistance is 50. So $50 is resistance for Hype. And even though Bitcoin is pulling back a little bit, Hyperliquid, one of the higher quality digital assets, if not one of the highest quality digital assets, is continuing to run. And something that's always interesting to me, Mike, is taking a look at the income statements for these protocols. So if we take a look over here, on DeFi Llama, just real quick, and we scroll down and take a look at, I'm looking for the income statement for Hyperliquid, not necessarily the layer one, but actually the trading protocol itself.
Mhm.
So here's the trading protocol itself. You can see the increase in TVL over time, also the fees. This protocol makes a ton of money. And if we scroll down and we take a look at the income statement for the last quarter, they made $141 million. That was net net. And so most of that got returned to token holders in the form.
Real quick, what is net net?
So, net of all expenses.
Okay,
And
so basically after expenses, that's what they profited.
basically, yeah, they
Okay.
did really, really well.
And if I'm
And
not mistaken, the holders of Hype, isn't there a way that they actually get a share, or that revenue is shared with them?
so, I think that's going to be part of what we talk about when we get to the news about, the SEC categorizing a bunch of digital assets yesterday as commodities and not securities. So I think that the way in which revenue is shared with token holders, it's not like token holders get a dividend. It's not like that. They would have to, stake Hype to earn yield on it, which is not the same as a dividend. But this token buyback last quarter of, and the quarter's not quite over yet. We still got a couple of weeks left in March, but this buyback of $166 million, that is not directly a dividend, but that's a way of returning value to token holders by shrinking the supply. So if the underlying protocol Hyperliquid is buying back the tokens that were minted and shrinking the supply, that would therefore make each token scarcer and likely more valuable. So that's what
Okay,
we're seeing with Hype.
so and I'm sorry, you cut out a little bit my internet connection. So were you talking about like buybacks and things like that, or
Yes.
okay,
Yep.
okay,
Yep. So this buyback, this token buyback right here, 99% of perp trading fees go to buy back Hype tokens.
perfect.
So this is, a lot of money every single month that's going to buy back those tokens. And you can see the income flow for the Hyperliquid protocol. So, this is a very profitable protocol.
Yeah, there's a lot of green on that chart.
A lot of green on that chart,
Yeah, we
This
like
is,
green is good.
yeah, green is good. I like green too.
All right. Well, next up, we got amazing news. It's the U.S. debt milestone. National debt has officially crossed $38.9 trillion. The high interest rate environment is now costing taxpayers billions in daily interest, fueling the debasement trade into gold and Bitcoin. So I posted this on X this morning, and with a very simple statement of this is why we are in crypto. This is why we invest in Bitcoin, because the dollar and the way that our government is managing the U.S. dollar and managing our economy is sending it into the tank. I'm just going to be blunt about it. And I have zero confidence in the US dollar. In the past couple of years, what I used to be able to buy, I can buy half as much, basically. Anybody that's gone to the grocery store, anybody that's adulting and they go to the grocery store, they go to the gas pump, anything like that. It's everything. What you used to buy for $100 now costs you $200. So I am heavily invested in crypto and any other asset that I can get my hands on that goes up in value to try to offset inflation. So what are you seeing? Do you see this slowing down or speeding up? I mean, what are you seeing on this, David?
I think it can only speed up, um, because it seems as though there's no political will to actually curtail deficit spending.
Mhm.
So get this, Mike, $7.2 billion per day. That's the current pace of borrowing. So the government is borrowing $7.2 billion per day. That is just an insane. It's so much, and we don't need to be spending money that we don't have. You know, uh, Citizens in America are taxed so heavily
Yeah,
that there's really no need to go out and borrow in order to spend even more. Um, and the drivers of all of this spend are Social Security, Medicare, and military.
yeah,
And really, the Social Security program is a Ponzi scheme, and Medicare is being looted by illegal aliens. So, like, if those two entitlements were cleaned up, I think that you'd go a long way towards balancing the budget. And also the military, military spend, contractors rip off the taxpayer.
Oh, absolutely.
So, there's so much waste, fraud, and abuse. And, you got guys out there on the ground like Nick Shirley who
Yeah.
are, pointing it out. And it seems as though nothing ever gets done about it. And the debt just becomes bigger and bigger and bigger. Eventually, it's going to matter. Like complex systems are weird, especially an entrenched complex system like the United States federal government apparatus and the US dollar. They fail slowly and then all at once.
Yeah.
So, and you know what? All you got to do is read history to know that every single world reserve currency has eventually failed. And they tend to last for between 80 and 120 years. If you go back over the past
Yeah,
500
the
years,
Real, the freaking British pound. I mean, you can go down the list. I mean, all the way back to the Romans.
right,
It's
right,
and,
but
and the
yeah,
template. The timeline is almost always the same. The debasement of the money, and just all the different aspects that play into it.
and the shame, it's really a shame because it doesn't need to be this way.
Yeah,
Like we could fix this, we could fix it now, but it's just easier to print and spend than it
yeah,
is to cut. It's easier to print than
yeah.
it is to cut.
To pass a budget and cut so that that there's they're spending less than they're taking in, so we can start paying down this. And I don't even know if it's possible anymore. I mean, how could they with the the interest, just the interest that we're having to pay? I just don't get. Well, I don't want to get too entrenched on this because we can go on about this forever. And tomorrow night, I'm sure when we get drunk during the red pill, we'll talk about this
I'm
topic.
sure. I'm sure.
All right. So next up, we got a Micron in TradFi. We got Micron AI explosion. So Micron reports earnings after the bell today. Analysts expect a staggering 464% jump in EPS to $8.80 as the demand for HBM3E memory chips for AI training hits an all-time high. What are you seeing on this?
Yeah. So you know how people have been talking about on social media recently that memory is extremely expensive now, that it's doubled or tripled. Well, who manufactures a lot of that memory? Well, Micron, right?
Well, and
So
they have a massive facility where I used to live at Point of the Mountain in Utah. Micron Sun Systems or something like that. And they have they build flash technology, flash drives, things like that. And I mean, this thing is monstrous. I mean, it's got to be hundreds of thousands of square feet at least. I mean, just it's this monstrosity. It's they call it Silicon Slopes. A lot of like Microsoft, Adobe, a lot of other software companies, because Utah is a lot more friendly to businesses when it comes to taxes and things like that. A lot of them moved there. So anyway, sorry, just a little bit of
yeah,
trivia.
yeah, yeah. So the funny thing about stocks when they run higher, after reporting blowout earnings, blowout quarter after blowout quarter, is Wall Street analysts start to expect that not only will they continue to beat, but that they will continue to beat and raise guidance. That's the important thing. Micron needs to not only beat, but Micron needs to also raise guidance for the rest of the year. And that might be difficult to do, but their expected gross margin is 68%. Okay, so these guys are doing extremely well. Micron has beaten the EPS estimates from Wall Street for the last 4 quarters. So for the last year, they've beaten and raised. But because the stock has rallied so aggressively, though, a standard beat today, I don't know would be enough. They need to beat and also raise forward guidance for the second half of this year, 2026.
Mhm.
So they've got 3 drivers here for their earnings. Number one is this high bandwidth memory, which is currently sold out. It's their
Mhm.
most advanced AI memory. It's called HBM3E. and
Mm-hmm.
it's reported to be 100% sold out through the end of this year. So, like, imagine,
So
imagine that.
they're back ordered.
Yeah, imagine that. Like, you run a business and you're completely sold out for the rest of the year.
Yeah,
Amazing.
that's a
So,
dream come true.
yeah, no kidding, man. And then they've got this so-called NVIDIA Nexus, where Micron, excuse me, has positioned itself as like a primary supplier for NVIDIA's latest chips. Think about that Blackwell Ultra platform that NVIDIA has been talking about recently. So that HBM3E memory is a prize for being 30% more power efficient than competitors. So everyone wants to use this stuff, and it's sold out through the end of this year. And HBM4 memory is already selling out into 2027. So this could last for a little while. People are referring to this as the memory supercycle. And memory supply for the first time in years is actually well behind demand. So spot prices for DRAM and NAND flash memory are up just in the first quarter of this year by nearly 100%. So Micron now has all this pricing power, and they're probably going to blow earnings out of the water. But the only way the stock continues to just rip higher is if they not only beat but also raise estimates or raise their forecast for the rest of the year. So take a look at this stock, man. I remember trading
I
this.
don't know how they could. I don't know how they could. I mean, if they're already sold out for the rest of the year, it's like how much more sales can they do?
I don't know, but take a look, man. That from the tariff tantrum low, last year, that's amazing. So from that tariff tantrum low, and let's call it $65, Micron, if we just go ahead and measure this, and this is not like, a shit coin. This is
No,
like a legit company that actually makes money. They're up 6x over the last not even a year, the last 11 months.
that's more than most freaking altcoins. Almost all altcoins made during this last bull cycle.
I know. I know. It's just amazing to see. Go Micron. This is an
Oh,
American company, I think. Yeah.
oh, absolutely,
Yeah. I'm pretty sure this is an American company. So I'm all for them. America. Go
Merc,
Micron.
absolutely. All right. So next up, looks like we got the software AI rotation. The traditional SaaS or software as a service stocks are now under massive pressure as capital rotates towards Halo companies, which stands for heavy or asset heavy with lower AI obsolescence risk. The Nasdaq is currently down 5% year to date. What do you got for us on that one?
Yeah. So did you get a chance, Mike, to watch Jensen Huang's presentation? I think it was either yesterday or the day before
I did.
on YouTube. Okay, so yeah, let's talk about this a little bit because he released. We were talking about OpenClaw, and Jensen Huang came out with a presentation about Nemo Claw, he calls it, and he was also talking about something called gas. So here's the thing. All these terms, Halo and Nemo and gas and SaaS, these are buzzwords, right?
Yeah, yeah.
But we've entered, over the last, year or so, this software slaughterhouse, right? Because all of these software as a service companies are losing their protective moats to AI. Think about it. If, I can, throw together a piece of software, or I can build a website, or I can,
Well, I mean,
build
all
and
the stuff that you're doing for us. I mean, it's you built a website. Me, you, and Don built an automated newsletter. You're building out, Bob, Bob and Associates. Our freaking, Bob's McCown
exactly.
that is going to do all of our social media. That's going to do all of our, accounting. That's going to,
I actually
basically,
got that running last night, Mike.
dude, I'm so fucking pumped for that because
Yeah,
the
me
amount of
too.
time that I spend, just on social media and just posting about the shows and things. It's such a time suck. But I mean, but like you're like what you're getting at, and I'm sorry I interrupted, but I mean what you're getting at is basically these software as a service, they're becoming obsolete.
Yeah, yeah. Not only are they becoming obsolete, but they really these companies really need to innovate in order to stay relevant. And
Yes.
so that innovation here, so we've got Halo, right? These Halo companies, so heavy assets, low obsolescence. And this was, I guess, popularized this year by a guy named Josh Brown.
Mhm.
They're calling this the anti-SaaS trade. Um, right. So this would be like energy and
Sassy.
utilities, yeah, companies.
Sassy.
I know, right? Or like logistics and transport companies or heavy industry companies. So there's that. But then this is, the Nemo gas trade. So this is what I find to be super interesting. So to describe the survivors of the SaaS world, you got to talk about Nemo Gas. And these are companies, software companies, that are transitioning from being, just tools to being more like infrastructure. So Nemo is that network effect moat, but government and gas, so virtual gas. This is all the stuff that Jensen Wong was talking about yesterday, and it might even be worthwhile for us to play some of that because these software companies, they need to transition into being more infrastructure companies to provide AI agents as a service. That's really what they need to become. So I want to see if I can find that video
That's
of,
what I'm trying to do while you're talking.
yeah. So, um,
NVIDIA speech.
yeah, so it was Jensen Wong yesterday, or
Yeah,
maybe the day
NVIDIA
before.
NVIDIA CEO Jensen Huang or Wang
Nemo
or
Claw. Yeah, it's about Nemo Claw.
Nemo Claw.
Um, yeah, so I've actually got the video pulled up, and it's only a couple of minutes, but
Go ahead and pull it
man,
up.
yeah. So it's right here. This is
Just
the
share it.
video. Let me go ahead and share this. And I've got this muted, but let me just open this up and let's see how this looks because I mean, man, this is like next level stuff here.
The models is radically different from biology to physics to self-driving cars to general robotics
Can you
to, of
hear
course,
this, Mike?
human language. And we have the ability to work with every single region to create their domain-specific, their sovereign AI. Today, we're announcing a coalition to partner with us to make Nemotron 4 even more amazing. And that
More
coalition
amazing.
has some amazing companies in it. Black
AR. More.
imaging company,
More.
Cursor, the famous coding company, we use lots of it, LangChain, billion downloads for creating custom agents, Mistral, the Arthur mentioned, I think he's here, incredible company, Perplexity's computer, absolutely use it. Everybody use it. It is so good. A multimodal agentic system, Reflection, Sarvam from India, Thinking Machine, Mira Murati's lab. Incredible companies joining us. Thank you. I said that every single enterprise company, every single software company in the world needs an agentic systems, need an agent strategy. You need to have an open clause strategy, and they all agree. And they're all partnering with us to integrate Nemo, the Nemo Claw reference design, the NVIDIA Agentic AI Toolkit, and of course, all of our open models. One company after another, there's so many, and we're partnering with all of you. I'm really grateful for that. And this is our moment. This is a reinvention. This is a renaissance of the enterprise IT. From what would be a $2 trillion industry, this is going to become a multi-trillion-dollar industry, offering not just tools for people to use, but agents that are specialized in very special domains that you're expert in that we could rent. I could totally imagine in the future, every single engineer in our company will need an annual token budget.
Right. So that's such a cool point that he's making, that your compensation as an engineer is not just going to be your salary, but your compensation is also going to be like you get a token budget. Because, dude, like I can't tell you, Mike, how much money I spend in Cursor. I would love to have a token budget. you know?
Well, I mean, it's something that's similar that they're doing on a Canton network is, running a validator or a node, or if you're a developer that's building on the network, you earn the Canton, token. So, and then you need that to use the network. So if you're developing on it and, if you're building, if you're, doing anything on the network to help grow the network, then you can offset the cost of using the network with that, that earning. So no, it's super cool, like tokenomics.
Yeah, yeah. Let's listen to Jensen. Let's listen to the rest of what he's got to say about Nemo Claw and launching it to the Open Claw community, because like agentic AI, where AI has hands and can actually do things, that's a really big deal.
Big Lou's
They're
asking
going
an
to
important
make a
question.
few.
Do you know what token?
So which, oh, what token? No. So token as in when you use these models, you spend tokens. Those tokens are basically equivalent to labor. And so as an engineer, you would have your salary, but you would also have a token budget. So it's essentially like AI work. You would have a budget for AI work. It's measured in tokens.
Well,
So
I mean, but I guess what he's asking is, and what I assumed is that there would be like some sort of NVIDIA token that you would earn, and that's what you would use to, pay to use the network or something like that. So he's wondering, did they launch like an NVIDIA token, or are they, or is it?
no. So I think that the terminology is similar, but I think it refers to different things. So,
Oh,
like, there isn't an NVIDIA token. Instead, each of these large language models, when you use them, the work that the models do is in
yeah.
the form of tokens. You spend
Okay.
tokens when you use these large language models,
Yeah.
but uh, it's not the same as a crypto or DeFi protocol token.
Gotcha. Well, I know, Big Lou's just a degen. I think he was looking to
He
FOMO
was
into,
trying to,
he was looking to FOMO
he
into
wanted
the
to,
NVIDIA token or something.
right.
$100,000 a year, their base pay. I'm going to give them probably half of that on top of it as tokens so that they could be amplified 10x. Of course we would. It is now one of the recruiting tools in Silicon Valley. How many tokens comes along with my job?
Right.
And the reason for that is very clear, because every engineer that has access to tokens will be more productive. And those tokens,
So it's not just more productive, it's like 100x more productive.
Hmm.
So,
as you know, will be produced by AI factories that all of you and us, we partner to build. Okay? So every single enterprise company in today sit on top of file systems and data centers. Every single software company of the future will be agentic, and they will be token manufacturers. There'll be token users for their engineers, and there'll be token manufacturers for all of their customers. The open claw event cannot be understated. This is as big of a deal as HTML. This is as big of a deal as Linux.
you hear what he just said there?
Mhm.
That this cannot be overstated. It's
Mhm.
as big of a deal as HTML. Like,
And
wow.
maybe just briefly explain the gravity of what HTML did.
Well, I mean, HTML allowed you to build websites,
Mhm.
so let me actually see here. So tell me about the importance of HTML. When was that language first created? It must have been in the 80s.
I would say
Um,
the 80s or 90s, because I mean, I'm old enough to remember before the internet, and I know that like there was Web 1, Web 2, and then now we're working on Web 3. But Web 1 was basically just informational websites where you would pull up a website with your dial-up modem, screaming at you, and it was basically just read only. And then Web 2 was, it allowed you to interact with the sites. So that's where shopping and things where you could click and actually interact with the websites, what became a thing. And then now you have Web 3, where there's the value. So basically it allows people to own their intellectual property and the things that that are on the web, to where it can be bought and sold, and things like that. So like your music, if you're a music creator, things like that. So yeah. Anyway,
Right. So, but HTML back in the day, back in the 1990s
the
was
1900s,
for, yeah, back in
way
my
back
day
in the
when we had to code websites by hand. We had to,
uphill both ways.
and in the snow, we were coding, Mike. But, back in the day when you were coding HTML on your horse and buggy in the snow uphill,
Yeah.
it was for like creating a visual display. And
Mhm.
then, in the early 2010s and 2020s, it was like for interactivity. But now it's for agentic interoperability.
Yeah.
So, like HTML now, they're talking about, how we talk about user experience, like user interface, user experience, UI, UX.
Yeah.
Now it's HTML for machine experience, because these AI agents, these claws, when you send an AI agent like those that are running on Nemo Claw, which is what Jensen Huang launched the other day, when you tell them to go book a flight or go scrape data, they don't see buttons like we do. It reads the underlying semantic HTML.
Well,
So,
and they're constrained, or they were constrained by paywalls. They couldn't navigate paywalls, and that's why X402 came out, and and some others, is to allow that you to give them a budget. So, like people like yourself that are building out things, you can create a wallet, and you can say, here's your monthly budget. I want you to spend $500 a month on whatever, and you can let it go, and it can actually navigate the paywalls. It can see the buttons. It can it can do everything now.
yeah. And not only can it do everything, but if your website isn't set up properly, like it doesn't have the right semantic HTML markup, then those claws, they're going to start doing a lot of stuff for humans that the claws can't see it, and they wouldn't be able to interact with your business properly. So HTML is suddenly really, really important because you need to position your website for agentic clause to be able to operate on it. So that means the website that I just built, I've really got to optimize it for clause.
Well, it used to be you optimized your website for the spiders or the crawlers from Google, so that it could index everything properly, and so that you could maximize or optimize your analytics and all of those things, so that you were higher up on search engines. Now it sounds like that the emphasis is going to be making sure it's optimized for these agentic AI agents. That's kind of the evolution that we're talking about here.
That's
So yeah,
exactly right. That's exactly right. It
super
is.
interesting.
Yeah. So this Nemo Claw, let's see what he's got.
We have now a world-class open agentic framework that all of us could use to build our open claw strategy. And we've created a reference design we call Nemo Claw, that all of you could use, that is optimized, it's performant, it is safe and secure.
I don't like when people say safe and secure.
I know. Optimized, performant, safe, and secure. Oh, Mike, you know what we should do when
What's
we're
that?
not streaming? You see on this is just like, jazz ambient or something like that.
Yeah.
We should like put together our own custom music, man, so that when we're not streaming,
Elevator music for when we're not live.
yeah, no, I was thinking it would be like, a combination, maybe different types of music, but maybe like cypherpunk or times like Bay Area hyphy or something like that.
Well,
That'd be kinda good.
we need to get Jeff to work on that, to where he can make a bunch of music.
That could be interesting. I
Well,
would
just
definitely
you
listen
got to
to it.
worry about the whole copyright strike thing. So we need to make our own music, or else we'd get friggin' in trouble, get our hands spanked.
Yeah, no, so I think we should definitely make some music, man. Definitely
Wow.
do that. Yeah.
Well, throw it up. I shared the document for the next meeting with you guys so that you could, add, any topics that you want to, cover in the next meeting. So, yeah, I mean, throw that on there.
100%.
All right. So in DeFi, RWA tokenization surge. Real-world assets now represent 14% of total DeFi TVL, $16.6 billion. Treasuries and private credit are the primary drivers as institutions seek on-chain yield. So we can pop on over to DeFi Llama. Or actually, no, let's go to rwa.xyz so that you can understand the gravity of this. So you can see that, this is something that we've been talking about forever. I like to show this quite often because as the market has pulled back, the total market cap of crypto has pulled back. It has not even slowed down the tokenization of real world assets. So bringing that value or that liquidity on chain. These institutions do not care about the price of these assets. They care about the utility of these blockchain technologies and what it means to their bottom line. They see the potential. They see, and as you've seen in the news and heard here, the stocks, equities are being tokenized. We're here in a second. We'll get into the CFTC, SEC news, but all of these things are being tokenized: real estate, private credit, U.S. Treasury debt, commodities. All of these, different illiquid assets are now becoming liquid, which allows a lot more flexibility in when and where they can be traded. If you can taking out loans against these assets without having to sell them, that is a major one. Because if you have to sell the asset to access that liquidity, you incur a taxable event, and often a very steep one, 20, 30% or more that you have to pay in short or long-term capital gains. However, with tokenized assets, you can take out a loan against the asset, retain that asset as part of your portfolio, and have access to that liquidity to deploy into other investments. So it's a way to almost lever up, your earning potential. So, if you believe in an asset long term, you can hold that all while, redeploying that liquidity to grow your business. Like, me and DeFi Don were talking yesterday after his show, at the end of his show after the lesson, about his issues as a very successful business owner with being able to get traditional loans from banks where they want, tax statements for the past couple of years. They want all this paperwork. And then you have some angry Karen sitting behind a desk that decides, no, you can't get that. When you're making plenty of money and you have, letters of intent, LOIs from potential customers saying that they are waiting, for you to ramp up production, so that they can buy what you're producing, but you need the money to ramp up production, and they still won't give it to you. So if, in Don's case, if his businesses were tokenized, he could take out loans with a couple of clicks, people like myself that are willing to provide liquidity to, successful business owners. And he would, in a couple of clicks, have the liquidity to scale up his business and off to the races. These institutions, they see this capability, they see this potential, and they're not slowing down. So what are your thoughts on this one?
Yeah, so there is definitely a surge in RWAs that's happened over the last year, but it really accelerated this year. And it isn't just about like putting things on a blockchain. I think it's driven by a couple of different catalysts. So number one, you've got yield arbitrage, and this is more like pure DeFi yields. So if you've got investors, in tokenized U.S. Treasuries and private credit, they're able to earn like 4 to 5% yield with much lower risk profiles than traditional DeFi plays. So that's number one. Number two, this is becoming like an institutional on-ramp infrastructure. Like BlackRock's Biddle fund and Franklin Templeton's fund. They've moved past their pilot phases, and now the last thing that they need is real regulatory clarity for this to just continue to accelerate, and for there to be even more adoption. And then you've also got this 24/7 capital efficiency, right? So the TradFi settlement cycle is usually T+2 and closes at 4 p.m. But these tokenized assets,
what's T+2?
yeah, so that's the settlement time. So when
Okay.
you place a trade, and you think, if you're in your traditional brokerage account, you place a trade, and then you see a P&L there, and then you close the position, and you think like, oh, this is all settled. It's
Yeah.
not. Settlement actually takes a couple of days.
Well,
But
and I wanted to point that out to everyone because it's an important aspect of this tokenization is, the finality, the settlement time is a huge part. So keep going. Sorry, I didn't want to
yeah,
interrupt.
yeah. So tokenized RWAs settle usually in either seconds or minutes, and they trade 24/7. So that it's called atomic settlement, which means that you can close a position and redeploy capital immediately. So
Yeah.
velocity of money goes straight up. And not only are we seeing this surge in RWAs, but these RWAs are no longer just static tokens that sit in a wallet. These are really becoming like primary collateral for the broader DeFi ecosystem. That's called composability. So all of these, tokenized treasury assets are becoming composable. They can be used as collateral in, different DeFi dApps. So let's say that you want to use your tokenized treasury asset as collateral to trade. Well, now all of a sudden you've got a collateral asset that's paying you yield that you can use as initial margin to open a position on a perp dex, let's say, that makes that collateral immediately useful, not just because it's yield bearing, but because you can use it on a bunch of different DeFi protocols. So that's really, really valuable. Now, Ethereum is the leader here, hosting 65% of RWA value. But there are other networks that are seeing, rapid growth too, like Solana, for example. So we're seeing this multi-chain mobility where RWAs can be bridged from chain to chain. And that's just going to, accelerate growth. So there's a couple of key players to watch here. Ondo Finance for treasury and bonds, BlackRock's Biddle for money market funds, again, treasuries. Centrifuge is for private credit. And then, Chainlink provides all the Oracle infrastructure for this stuff. So,
It's
yeah.
funny that you mentioned Ondo and Centrifuge. It's after the next headline, we'll be talking about that, but keep going.
Yeah. Yeah. So, I mean, look, tokenized RWAs are without a doubt going to continue to see massive growth. It's
Yeah.
just how do you as a retail investor really benefit from this? Because many of these protocols, they've issued tokens, but they're dog shit. So like, how do you actually make money from this?
Well, and please, detail that because it's something that we talk about here a lot. It's something that you taught me is, basically if you're buying a token and the tokenomics of that project, if there's no mechanism in place to where that revenue is shared with token holders, you're basically buying a meme coin for a success, a successful business. You're a fan of that successful business because there's no way for that revenue to make it to token holders. So there needs to be something like when David was talking about hyperliquid, where there's buybacks, and things like that to reduce the amount of tokens in circulation that potentially could drive the price up. If there's revenue sharing of some kind, through governance or voting and things like that. There has to be something in place to where you as a token holder make money. Otherwise, again, you're holding a meme, a baseball card. You're wearing the jersey of your favorite crypto team. But sorry, go ahead, David.
Yeah. So you see the chart that I brought up, Mike, the chart of Ondo. So, this one is just interesting to me because, all of the metrics that you might track on, something like DeFi Llama, maybe you might track something like total value locked, or you might track something else, fees generated by the protocol. Those metrics seem to be all going in the right direction, right? Like, you're seeing TVL up, near $3 billion, and the protocol itself seems to be making a lot of money in fees. But obviously, that's not feeding through to the token itself, the Ondo token.
Oh, I
So,
hold on, though. I know it's not
yeah,
it's not going up. I mean, you can watch all the good news come out, and all these companies using Ondo, and the price does nothing.
right. So, if there is a tenuous connection at best between the underlying protocol and the token that the protocol issued, well, then you're probably holding something close to a meme. So like, if we zoom in here on Ondo, this looks like complete shit.
Yeah,
And if it breaks down below 19 cents, which I think is likely, then you got to start thinking about all-time lows at like a penny,
yeah.
because like there's no support down below 19 cents for Ondo. And now that digital asset markets are starting to roll back over a little bit, with ETH down 6% today after being up like 8% yesterday, basically giving it all back, not yesterday, but the day before. So giving the entire move back, that makes this a false breakout. And that could be all she wrote for the March rally out of digital assets, unless Bitcoin is able to not break down below like 62 and a half. But for something like Ondo, you've got to take a look at its income statement, and that's here over on DeFi Llama. But
Yeah.
I don't know why we're missing data from November to present. So no data from November to present, but you've got the data basically from like June to October of last year. And from June to October, this looks pretty positive. But if token
Well,
holders,
what happened in October?
oh right, yeah, flash crash, flash
Right?
crash, yeah. So I mean, you really, really need to dig into the tokenomics before you buy any token, because these digital assets, there's literally, I want to say like two, maybe three, that have outperformed Bitcoin. Um,
I know
and that's
Hype
it.
can are two of them.
Yeah. So, here's hype. Here's hype. If I bring up hype. Um, so let me just make sure that I'm sharing the right screen. I want to bring it on over to TradingView. So hype up 3.5 percentage points today, just continuing to push higher. But the way that you know that this is outperforming Bitcoin is if you price this in Bitcoin terms, like so,
Mhm.
then what you'll see is fresh all-time highs. You see that?
Relative to Bitcoin, yeah.
Relative to Bitcoin, fresh all-time highs. So this is outperformance. This is what outperformance looks like. Now, let me
Well,
give you
and
another example.
honestly, those are the assets that you want to focus on. Is ones that when the rest of the market is bleeding, or trending sideways, they're moving on their own. They're not correlated to the rest of the market. They're decoupling is the term that people like to use.
Yeah, you want to buy the best and sell the rest. So hype is definitely one of the best, if not the best.
I'm just
Take
waiting for a pullback. I'm going to be selling some of my other bags and buying hype because I have no exposure to hype. I'm just waiting for a good entry.
Yeah, I mean, it makes sense to me. I think that if Bitcoin really starts to correct again back down towards its 200-week moving average at like 59 or 58K, I think that every digital asset will get sold, including hype, which would
Mhm.
probably give you an opportunity to get a pretty good entry. But another one that has outperformed so far this cycle has been Tron. Like, you might not think it, but this, which is basically a stablecoin chain, Tron was up 7x from trough to peak this
Yeah.
past cycle. But the interesting thing about Tron is that it hasn't really given it back, on the downside.
And
So
hardly
again,
anybody talks about Tron too.
I know, like, I talk about Tron now every day. And, here's Tron in Bitcoin terms, right? So Tron BTC, this is the daily, but this over the last couple of years, this is what outperformance looks like. So there's the low and moving to the upside against Bitcoin. This is Tron outperforming Bitcoin. So push a little bit higher, and Tron in Bitcoin terms could see the highest levels since 2019 in Bitcoin terms. So
Damn.
that's major outperformance there.
Yeah.
So basically Tron hype, and I mean that's it. Like, you know, I don't know. I can't even think of another one. If you wanted to take a look at Canton, you could.
I think I mean it's been doing pretty well.
Yeah. So you know, here's Canton. Now the thing about Canton is that we've got very little data, kind of like hype. You know, one of these newer tokens. But if we just go ahead and price this in Bitcoin terms, right? Just like we did with the others, this is again what outperformance looks like. So you've got this series of, let me just go ahead and grab my brush. So here's the low, that's the all-time low in Bitcoin terms, higher low, higher low. Here's a high, higher high, higher high right here. This is what outperformance looks like. This is the definition of an uptrend. So, you know, you've got Canton, you've got Tron, you've got hype. Can you tell me another token that's outperformed Bitcoin? You know
what? Take a look at it's not Pol or it's not Matic anymore. It's Pol, P-O-L. I keep hearing people talk about how Matic is like this quiet pumper. I haven't looked at it.
It looks like a pretty shitty dumper. I don't see any quiet pump here.
So basically, it's just people trying to pump their bags, talking about it.
Just retarded. Like, dude, Polygon, ugh. You know, and so here's the Matic token.
Well, I know Polygon is like number 9 when it comes to RWAs. That's kind of why I wanted to take a look at it.
Yeah, I mean,
dude, freaking Plume. Plume is moved up to the number 10 spot as far as networks and RWAs. In the past 30 days, it's up 67, almost 68%.
Wow.
Take a look at the TVL. See if it took a huge dump in TVL. I still hold a sizable bag of Plume. Oh, it looks like it did have a little bit of a pump, but it lost it.
Yeah, I mean, people, you know, use that pump to exit, it looks like. So yeah. Stable coins, though. There's some stable coin market cap on Plume, it looks like. Now, does this one have a token, Mike?
Yeah, Plume. It has a token. Yeah, I have a decent bag of it.
I'm sorry.
No,
sorry,
honestly,
Mike.
I'm gonna hold on to it. I've have it in some DeFi, and it's just earning Plume. But they have a great ecosystem. I mean, it doesn't mean it's going to be successful, but they have a great RWA. It's purpose built for RWAs. It has Nest credit on it, so there's a bunch of different institutional, as far as vaults and liquidity pools and things like that, institutional grade. There is a interoperability between Plume and Base Network. So, I mean, it has potential. I'm not saying go out and buy this project. Do your own research. I have. It's one of my long shots. It's one of the ones I'm swinging for the fences on. So again, do not run out and buy Plume, unless you just want to buy a small bag just in case it does a 10x or a 20x or something. But yeah, don't ape into this thing.
Yeah. So again, this is kind of like Ondo, where it's the token is completely disconnected from that underlying protocol. So like, Ondo, yeah, issuing like, helping with RWAs and stuff, but Plume, it sounds like maybe doing something similar. Its token, however, looks like some institutional grade dog shit.
Yeah.
And,
no, absolutely. That's why I'm saying this is a long shot.
Yeah.
I have, invested right now is I'm at about break even.
Amazing.
I got in pretty freaking early, and then I earned a bunch of Plume when it first came out, like massive amounts. I was making like, like a couple thousand%, APR, built up a really nice bag, and then it got to where it was making like 300%, and then it just went, basically I pulled it all out because it got to where it was like at 30% or something like that. And so yeah, I'm just sitting on a really nice bag, and I'm just going to see what happens with it.
Yeah, you see what Bitcoin Mouse is saying? He's saying
Yeah.
no such thing as altcoins. Yeah, well, there is such a thing as altcoins, and most of them suck. It's like, you know,
It's
and
the truth. Like I said, I mean, I'm going to be honest about, I'm not going to try to, pump my bags or, shill my bags or anything like that. I'm going to tell you if it's a long shot or not. I did the same thing with Casper Network. I thought that, Casper was going to, be, successful and stuff like that. But I always told people, it's a long shot. I liked the team. I liked what they were doing. And it all ended up being, kind of smoke and mirrors. Well, not smoke and mirrors. It's just, it was one of those projects like most of them out there where there was always this big news about a new partnership, and it's just nothing ever really materialized. It was always like, hey, we're in talks, or, we're building out. They were building IBM's freaking Watson. They were building out their AI on a Casper network, and then out of nowhere, Casper Labs and the old CEO broke off from Casper Labs, went over to HBAR, Hedera, and started building it there. And it was always something. And so it's one of the ones that I've sold off my bag of. I have a very small moon bag just in case, it does like some phoenix from the ashes, but I don't think it will. But it's a couple $100. We'll see.
yeah, I mean, sometimes these tokens do, just a 10x out of nowhere, kind of like HBAR did.
Yeah,
Everyone gets all excited for no reason, and then they give it all back.
that was the ISO pump.
Yeah,
XRP, XLM, HBAR, Algo, all of those ISO 20022 narrative tokens, right after Bitcoin started pumping, they all took off. And that's what David's pointing out. And then Trump came out with his meme coin, and Melania came out with her meme coin, and it sucked all the liquidity into those tokens. And the people that got in early on those tokens sucked all that liquidity out of the market, and it just sucked all the air out of the room. We never
yeah.
really had an alt season after that, and then you had October 10th happen, where everything took a shit, and it was just like a 1-2 punch. Between the Trump meme coin and October 10th, the market just never popped back from that, and we never really saw an alt season.
Yeah, and taking a look at something like Trump, the Trump token, the meme coin token here, um, you know, I actually did really really well with this one because the day it launched, the first 24 hours,
Yeah.
I was providing liquidity in this thing, and
So
I
people
did.
trying to swap into it and things like that.
Yeah, so I did well with that, but I was only in it for like 6 hours, and then I got out, and thank God I got out because look at this, man. Ugh.
And you would have been epic if you would have shorted it. If you would have provided liquidity and then shorted it.
Oh man, yeah. Takes some balls to do something like that because
Yeah.
when one of these tokens launches like this, and you get this crazy epic volatility, you can just as easily sometimes get a pump as you can get a dump.
Yeah.
So unfortunately, for holders of the Trump token, this thing looks like it's probably going to zero at some point. So
Yeah.
yeah.
All right. Well, let's pop a couple of these last news stories, and we'll get on over to a lesson. So let me cherry pick some of these. Well, I was teasing it, so let me do this one next. Institutional on ramps, Ondo Finance and Centrifuge have expanded partnerships with Janus Henderson to bring tokenized ETFs, ticker JTRSY, to institutional allocators, with RWA holders growing over 600,000. So that's quite the onboarding that they're doing. But just to refresh people's memory, Ondo Finance and Centrifuge, those projects are purpose built for onboarding traditional assets and to tokenize to tokenize them. So that's basically what Ondo and Centrifuge is all about. So what do you got on this one, David?
Yeah, so private credit, that's centrifuge. Private credit has been getting into a lot of trouble recently. Let me see if I can dig up anything about centrifuge and private credit, because I don't know if you've seen, Mike, in TradFi news, all of those private credit funds that have been forced to gate withdrawals, because basically, like their portfolios, there's a duration mismatch. So if a private credit portfolio has lent to a business over the course of 5 years, they've got a 5-year term on that loan, but investors are demanding their money back now. Well, these private credit funds don't have the cash on hand to be able to make their investors whole. If everyone comes to them all at once and says, hey, we all want our money back, well, the loans that were made, these are not liquid. They're not liquid products. Like, they can't just give back the money to their investors. So they've been gating that. But here's the thing: private credit in DeFi, this is what centrifuge is all about. So private credit involves non-bank institutions like these investment firms lending directly to companies. So in DeFi, this process is tokenized to remove these intermediaries. So the problem is that you've got these small and medium-sized enterprises, or they're called SMEs, and they sometimes have a really hard time getting bank loans. But DeFi investors want yields that aren't really tied to crypto market volatility. So that's the problem. The solution is that a company can sell its debt, like an unpaid invoice or a mortgage, to a DeFi protocol like Centrifuge. And so the protocol is going to issue tokens against that debt. And those investors are going to buy those tokens, and they're going to be able to earn the interest paid by the borrower. So Centrifuge works like this tokenization factory. So you've got on-chain asset origination. So a company, the originator, provides proof of a real-world asset. Let me give you an example. Something like this: maybe an invoice, a $100,000 invoice that's due in 60 days. So Centrifuge mints an NFT, and that NFT represents the legal claim to that specific invoice. Then there's the pool. That NFT gets added to a pool of similar assets. And then investors deposit stablecoins like USDC or USDS or USDT into the pool to fund those loans. And then there's tranching, which is just the practice of breaking up large pieces of these pooled loans into, they're referred to as tranches. That's for risk management. So Centrifuge splits each pool into 2 tranches to suit different investor appetites. You've got the senior and the junior tranche. The senior is called the drop token, lower risk, lower return. These investors are paid first. And then you've got the junior tranche. That's the 10 tokens, and that's higher risk, higher return. So those investors take the first loss if a borrower defaults. So yeah, Centrifuge, kind of interesting. They got a partnership with Apollo in late 2025. It's like a feeder fund for the Apollo Diversified Credit Fund. So that brings private equity credit onto blockchain. And they partnered with Sky, which was MakerDAO. They rebranded as Sky Money. They are now the primary vault for Sky Money. So it looks to me like these 8 to 12% yields are pretty attractive for many investors. But here's the problem. There have been a bunch of private credit funds that have been blowing up recently. The gated withdrawals for private credit funds recently. Let's see, because there's Blue Owl, and then BlackRock recently had to gate some of their private credit funds.
And by gating, what David's talking about is they limit the amount of liquidity, if at all. They might halt all withdrawals because, like he said, they don't have it available because it's in assets that they can't liquidate. to pay people back. And so that's what David's talking about here.
Right. So, here's BlackRock with their H-Lend fund. It's a $26 billion fund. They had to gate it. Morgan Stanley had to cap redemptions. It's called gating. Blackstone had to cap redemptions. Blue Owl had to cap redemptions. And, a lot of these are publicly traded and their stocks look like crap. Famously, Jamie Dimon was warning of cockroaches in the private credit space. So, when one starts to blow up, that means that there's probably a lot of others that, the so-called cockroaches, right? And it's a get out first type mentality. So not good, not good.
We got about 40 minutes left, and I want to make sure that we leave plenty of time for our lesson for today. Just so people know, tomorrow we're going to have Colin on as our guest. He's one of the he's one of the original members of AVAX, Avalanche. And then on Friday we're having Jonathan from Block
Turtle. Mm-hmm.
Yeah. So an interesting project. We'll be talking to them. So our big story today, though, is yesterday marked what many are calling the end of an era of uncertainty for U.S. crypto regulation. So we're waiting for the Clarity Act, but in lieu of that, the SEC, Securities and Exchange Commission, and the CFTC moved from years of jurisdictional turf wars to a unified pro-innovation stance. Here is the breakdown of the massive news from yesterday and today. The 16-asset landmark declaration in a 68-page joint interpretive release issued yesterday, the SEC and CFTC explicitly named 16 major crypto assets as digital commodities, confirming that they are not securities. On that list, Bitcoin, Ethereum, Solana, XRP, Dogecoin, Cardano, Avalanche, Chainlink, Polkadot, HBAR, Litecoin, Bitcoin Cash, Shiba Inu, Stellar XLM, Tezos, and Aptos. Why this matters? It effectively strips the SEC of its previous regulation by enforcement authority over these specific assets, moving them primarily under the CFTC's oversight. So if you don't know, the Securities and Exchange Commission, they specialize in regulating securities, as hinted by their name. So this is why the CFTC would have oversight instead of the SEC. SEC Chairman Paul Atkins, we are not the SEC of everything. Atkins, who took over with a mandate to reform the agency, delivered a keynote at the DC Blockchain Summit yesterday. The pivot, he stated, that the SEC will now acknowledge that most crypto assets are not themselves securities, a direct reversal from the previous administration of everything but Bitcoin stance. Our favorite guy, from before, that was the mouthpiece and the pawn of Elizabeth Warren. So good, that's good. Proposed regulation crypto assets. Today, Atkins is floating a new safe harbor framework, which includes a 4-year startup exemption, allowing projects to raise up to $5 million with minimal disclosure to allow them to reach decentralization before facing full regulation. Safe harbors for staking, mining, and airdrops. The joint guidance provided a long-awaited clarity on protocol-level activities. Mining and staking classified as administrative and ministerial activities. They are officially not securities transactions. Airdrops. The SEC clarified that most airdrops do not meet the investment of money requirement of the Howey test, removing the threat of unregistered securities charges for simple token distributions. Joint SEC-CFTC Project Crypto. CFTC Chairman Michael Selig confirmed today that both agencies have fully harmonized their token taxonomy. The 5 categories. Assets are now officially categorized as digital commodities, digital collectibles, which are NFTs, the pictures, digital tools, stablecoins, and digital securities. Unified enforcement. If a case overlaps, the agencies will now confer on charges rather than filing competing lawsuits. So that's huge, because instead of fighting two separate lawsuits, if they are served, then it has to be in one lawsuit, one combined lawsuit. So that will cut down on the amount of money that these projects that put a lot of companies out of business under the last administration. So what do you got for us on that, David?
I actually have something really interesting, Mike. So if you take a look at the screen share that I've got up here, so this is, I put together a bunch of content on this specific release because
Well,
this
if it's
is,
enough content, maybe this is the lesson for today.
yeah, I think it definitely could be. So I put together 3 different pieces of content here. The first one, we should probably take a look at this first, this infographic, just so that we know what we're looking at here. So, this is the SEC, CFTC regulatory shift, and somehow XRP was ruled as a commodity. These guys must be completely retarded. Like, dude, really? Like XRP and ADA are commodities, and Doge is a commodity? Like, what the fuck are they talking about?
And Shiba Inu, like, really?
Dude, what? What? Like,
Me?
who lobbied to get Doge and Sheeb and XRP and Cardano, and all the rest of the shitters? Like, who lobbied to get those labeled as quote unquote commodities?
Yeah.
Like, those are clearly securities, most of them. But I guess not under this administration. So
I wouldn't even call them securities like XRP, because there's nothing that ties, there's no contract that ties the success of Ripple to token holders. They have absolutely no legal obligation to the token holders, of XRP. So I mean, it's one of the pillars of the house.
But it depends on who they're selling it to, because if you're selling XRP to an institution, the token, then there is, and that would be illegal. But if you're selling XRP to retail, then there is not. And so it basically has made it legal to dump these shit coins on retail, which is like horrible, horrible, horrible. I don't think that either the regulators are completely bought and paid for by lobbyists, or they don't actually understand what it is that they're regulating, or they don't care. But let's take a look at this. This will be interesting. This is that new type of cinematic content created by Notebook LM. And this is all about, the paradigm shift. It's analysis of the SEC, CFTC joint release from just yesterday. So I think this will be really good. Let's take a look at this, Mike.
For over a decade, the digital asset industry in the United States operated in a regulatory gray area.
No.
Market participants navigated a chaotic environment defined by regulation by enforcement, where disparate judicial outcomes served as the only legal authority. This friction stemmed from the aggressive application of the Howey test, a 1946 legal standard used to identify investment contracts to decentralized software code and blockchain networks. That jurisdictional turf war ended on March 17, 2026, when the Securities and Exchange Commission and the Commodity Futures Trading Commission issued a joint interpretive release to establish permanent rules of the road. The 68-page document is the first major output of the interagency Project Crypto initiative, spearheaded by SEC Chair Paul Atkins and CFTC Chair Michael Selleck. This joint release replaces a decade of regulation by enforcement with a functional, permanent taxonomy for digital property. The first major intellectual shift is that regulators officially abandoned the rigid binary question of whether a token is a security or not. In its place, the agencies created a modular, 5-category taxonomy based entirely on a digital asset's economic substance and its functional utility within its specific ecosystem. Second, the agencies dismantled the SEC's long-standing precedent that once an asset is sold as part of an investment contract, it remains a security in perpetuity. This chart introduces the attach and detach doctrine. A single digital asset's legal classification is no longer static. It can legally transition and change categories over time. This temporal flexibility solves the industry's biggest compliance hurdle. Centralized crypto startups can now raise capital legally and eventually mature into decentralized global networks without carrying the regulatory burden of a security forever. The new taxonomy creates 5 functional categories: digital commodities, digital collectibles, digital tools, payment stablecoins, and digital securities. By splitting asset classes, each gets a dedicated regulator. Non-financial utility categories include digital tools, acting as access credentials, and digital collectibles, encompassing cultural assets like NFTs. The SEC noted a strict condition for collectibles. If an issuer fractionalizes these assets or explicitly promises managerial efforts to increase the collection's value, they revert to being scrutinized as investment contracts. The payment stablecoin category integrates directly with the Guiding and Establishing National Innovation for U.S. Stablecoins, or GENIUS Act, passed in 2025 to create a federal stablecoin standard. Under the GENIUS Act, issuers must maintain strict one-to-one fiat reserve backing and offer zero yield. Meeting these rules removes the stablecoin from SEC and CFTC oversight entirely, transferring jurisdiction to federal banking regulators like the OCC. Traditional tokenized financial instruments, such as tokenized treasury bonds, equities, or debt, remain classified as digital securities and operate under total SEC oversight. This modular categorization replaces legal ambiguity with functional boundaries for every token type. This grid details the immediate market catalyst provided by the release, an official list of 16 specific crypto assets explicitly granted digital commodity status. Inclusion on this list provides these specific networks with immediate ironclad legal protection against allegations of conducting unregistered securities offerings. Agencies applied the objective 3-pronged programmatic standard. First, intrinsic functional linkage. The token is technically required to operate the network. Second, decoupling of managerial dependency. Value is driven by market dynamics, not a central team. Third, functional maturity. The network must be operational. These 3 pillars ensure that commodity status is granted based on measurable technical benchmarks, rather than subjective case-by-case decentralization tests. This timeline breaks down how the Howey test is dynamically applied to early-stage projects, starting in the attach phase. Attachment occurs when a technically neutral piece of code becomes legally bound to federal securities laws during a project's early development. This legal binding triggers when an issuer makes explicit promises to undertake essential managerial efforts that will generate profits for early token buyers. The SEC set a high evidentiary standard for this phase. These binding promises must be delivered through official channels, like regulatory filings or formal white papers. Third-party social media hype does not create an investment contract. The attach phase serves a specific regulatory function. It allows the SEC to police centralized capital formation and protect investors without permanently condemning the underlying network code. As the network matures, the timeline moves into the detach phase, where the application of the Howey test officially expires. Detachment triggers under 2 conditions. Either the centralized issuer has fulfilled or abandoned their initial promises, or the network has achieved technological autonomy. Regulators encourage projects to self-certify this autonomy using objective decentralization audits. These audits rely on primary metrics, like the Nakamoto coefficient, which measures the minimum number of nodes required to compromise the network, and the Gini coefficient, which tracks the concentration of token wealth to ensure a broad economic base. They also analyze secondary metrics, including the physical geographic dispersal of validators and the percentage of protocol updates made by non-affiliated independent developers. Once a network achieves detachment, regulators provide blanket safe harbors to protect ongoing protocol-level activities. Core operations like protocol mining, solo and liquid staking, and token wrapping are now defined as ministerial functions. They are completely exempt from securities laws. When an investment contract detaches, secondary market transactions are permanently decoupled from the original offering. The token trades purely as a commodity. The sudden elimination of long-standing legal uncertainty triggered an immediate, massive reallocation of institutional capital into digital assets. In the 3 days following the joint release, spot crypto ETFs experienced a record $1.7 billion in net inflows. Anticipating a streamlined approval process, asset managers like Bitwise and Fidelity updated or filed new spot ETFs to track the 16 newly classified digital commodities. In parallel, the SEC executed a regulatory spring cleaning, removing historical barriers that previously pushed digital asset innovation offshore. The agency rescinded Staff Accounting Bulletin 121, a rule that previously prevented U.S. banks from holding digital assets, and withdrew the restrictive safeguarding rule for investment advisors. Removing these barriers enables U.S. banks and broker-dealers to legally custody assets, bridging the operational gap between crypto networks and traditional Wall Street infrastructure. While it provides 80% of the necessary clarity, as an agency rule, this interpretive release lacks statutory permanence and could be rescinded by a future administration. To lock in these regulatory gains, the industry requires the passage of the pending Digital Asset Market Clarity, or Clarity Act. The Clarity Act establishes formal, statutory registration pathways for digital commodity exchanges, brokers, and dealers directly under the CFTC. It also explicitly preempts state law by classifying digital commodities as covered securities, preventing states from imposing inconsistent or duplicative registration requirements. While the Clarity Act is the final destination, the SEC CFTC functional taxonomy and dynamic lifecycle doctrine have successfully built the durable bridge to the next generation of United States financial innovation and global market leadership.
Wow. That was pretty interesting. That was a pretty pretty detailed piece of content. Wouldn't you say, Mike?
Yeah, no, it actually played well into that, the kind of the big news story of the day, because I mean, those of you that maybe haven't been around in crypto that long, last bear market, that whole bear market under the Biden administration, you had Gary Gensler, who was, basically the head of the SEC, and it came out, it's a fact that Elizabeth Warren, she's I want to say she was the head of the finance committee.
She was the lead Karen.
Yeah, lead
Yeah.
Karen of the finance committee and the
Yeah.
mouthpiece and the pawn of the banks. And she was, pretending like she was, going after Gary Gensler for not, enforcing the rules enough. And so, he was going after Ripple and, a bunch of other companies, and put a bunch of companies out of business because they couldn't afford, the legal fight, the deep pockets of the U.S. government, because they have, armies of lawyers on staff, and they got caught. She was sending him emails with the questions beforehand and asking him to look over the questions and let her know if he needed her to tweak any of the questions. So it was basically all theater, where supposedly she was going after him, and he was kind of they were basically it's kabuki theater. And so it ended up to where Judge Torres, Ripple, hats off to him, had enough, XRP to sell to where they funded, a massive legal battle, spent hundreds of millions of dollars from, of liquidity from people buying XRP and, other liquidity to fight the SEC, and actually halfway won, depending on your point of view, I guess, because what David mentioned earlier, institutional sales of XRP are considered a security, according to Judge Torres, but retail sales are not. I was one of the XRP holders that celebrated that, not understanding that that actually was bad for retail, because if it was a security, then we would have had a stake in the company of Ripple. Because it's not a security, then they have no legal obligation to token holders and can just sell, out of the escrow that 1 billion tokens a month get unlocked out of. They can just keep selling those escrowed tokens on the head of XRP holders to fund the growth of Ripple that they're trying to build into a bank now. So they've kind of gotten away from the business model where they were going to replace Swift for cross-border payments and all that kind of stuff. Now they're jockeying to become a global bank, and they're using XRP to fund that. So anyway,
So Mike, can we hop into that slide deck that I'm showing right now?
Yeah.
I really want to take a look at this. So this is check this out, everyone. This is kind of cool. So let me go ahead and run through just a couple of slides here because I don't really I don't really understand how this is legal. All right. So check this out, Mike. Take a look at the official list. So this is the 16 recognized digital commodities, right? You got foundational or layer ones. So you could actually say that more than just these are layer ones. So it says Bitcoin is primary, Ethereum, proof of stake commodity, Solana, high speed utility, Cardano. I guess there's some utility there. I'm not quite sure what it is. AVAX, it says sub network utility. I guess, if you say so. Aptos, it's just so funny. Aptos and Sui are very similar projects. Why didn't Sui make it onto this list? Aptos did. Aptos is, like, I think, worse than Sui. I think Sui's better than Aptos. So it's just kind of funny that Sui didn't make it on here. Aptos did, though. I bet the guys at Aptos had better lobbyists, better lawyers, man. Tezos made it on. Not quite sure what Tezos does, but it's being called a foundational layer one. Mike, do you know what Tezos does?
I don't. I'm familiar with the token, but I've never invested in it.
Yeah, I mean,
I'll look that up while you keep going.
So here I've got a chart of Tezos, man. Check it out. This is what Tezos does. It's one of those down only tokens. You know those? The ones that do nothing but just dump.
Lower high and lower lows.
Lower highs, lower lows. Let's see if we can just, and look at that. We go back in time. So that was negative 80%, but that's only from November of 2024, Mike. So what we got to do here is we got to zoom out. When in doubt about the shittiness of the shitters, zoom out and then measure from the all-time high. Oh, dude, that's nice. 96% down. So, but somehow this made it in to the SEC CFTC statement as a foundational layer one.
One thing that we gotta, that we pointed out before, and we gotta, reemphasize is that price discovery. Like real, true price discovery for a lot of these assets, has been purely speculative, and as we move from a speculative market to a utility market, and these companies, start to get their valuations done, in these tokens, the kind of the real value, not the speculative value, is realized. Taking into account the tokenomics and the TVL, all those different aspects. Some of these tokens that historically have had $1, $10, $100 per token valuations might end up being worth a couple of cents. And it's a very real thing that we need. And I know a lot of people are going to think this is FUD, and on crypto, but you need to be real. A lot of these assets, their actual value could be a lot less than they are right now.
Yeah, I mean, it does depend. Like, it really matters when you bought. But all I'm doing right now is I took a screenshot, Mike, of this list of 16. This is the sweet 16. I don't know. Some of these don't look all that sweet to me, but that's okay. So this is the sweet 16, and these are, I guess, the official 16 recognized digital commodities. And I just want to find out, like, how have they performed over the last 12 and 24 months? I'm pretty interested to find out, what has been their performance here. And I'm going to put together some research on that for everyone in the school community. But, I don't even need to put together research on this, dude. I know how these are performed. Bitcoin is down 60% from its all-time high, one of the outperformers on the list. In fact, I don't see anything on this list that has outperformed Bitcoin. And none of these, all of these have massively underperformed Bitcoin. Maybe they should have added hype to this list.
Well,
maybe.
they would have had it. They at least would have had something on there that was, outperforming Bitcoin.
I mean, dude, like they literally classified a bunch of dog shit as like the top 16. Like,
Well,
how
dude,
does
like
that make sense?
Hype is up, like 19% in the past 7 days. It's up 7.2% in the past 24 hours and 3.2% in the past hour.
Yeah, Hype has been doing great, but you take a look at settlement and interoperability. Like, I mean, really? Like what type of settlement and interoperability has been going on with XRP, XLM, and DOT,
Dude, I'll take us to the XRP scan, and I can show you.
None. The answer is none, not much.
Well, I'll let the data speak for itself.
Yeah, it's just so weird.
So this is XRP scan. If you want to do your own research, you don't have to listen to me, but go to metrics and the aggregate. You can look back and let's just go to all time. So we got, it's definitely up since 2014, but in the past year, there's been no growth in the number of payments from one account to another. You can see, back here, it's pretty much exactly the same. So all of this good news, all of the Ripple news and the growing and everybody talking about XRP, there's no growth when it comes to the number of payments from one account to another.
Right, but even that, Mike, like I would even be dubious of that, because what exactly is a payment from one account to another?
From
What
one
exactly?
from one XRP wallet to another.
Yeah, so but what is that actually useful for? Like, what does that tell you? Because it doesn't really tell you if those are individual humans. It doesn't tell you like the value of the payment.
Regardless, there's no growth. So, I mean, even if they're trying to overinflate, by skewing the data, there's no growth. So,
Right.
if it's a person or not, if it's a bunch of bots, you would think that there would just be massive, or they would, at least show some growth. But there's nothing. And this is from the XRP ledger. This is data from the XRP ledger.
So what about the rest of them? There's XLM, there's Polkadot, there's Litecoin, there's Bitcoin Cash. Like, why did Litecoin and Bitcoin Cash make it on there?
Bitcoin Cash, I think that Bitcoin Cash probably made it because isn't it similar to Bitcoin? When it comes to its decentralization and all that stuff.
Yeah, it's a fork. I think that both Litecoin and Bitcoin Cash are forks of Bitcoin.
That's probably why.
Pretty sure.
Yeah, that would be my guess of why is they would fall under that same umbrella because they have basically the same architecture, the same layout, the same, everything's the same.
Right, but do they though? Because the things that are used to like officially determine whether you move from the attached phase to the detached phase. And I'm assuming that all of these 16 tokens, Mike, if you bring it back to the slide deck, I'm assuming that all, yeah.
Hold on real quick. I just want to finish this train of thought because it's really important because, I mean, XRP is shilled so hard. People need to understand, where to find this data. But like number of active accounts has declined. And I'll just burn through this real quick. XRP burned is fees. This is a representation of the use of the XRP ledger because XRP is the gas token that is burned, 0.00001 XRP per transaction. You can see in the past year, there is a huge drop off in the usage of the XRP ledger and fees being burned. Number of transactions executed, it's pretty much the same. Nothing has changed. This is a stagnant ledger, a stagnant blockchain. There isn't growth here. No matter, Ripple has had a ton of really good news where they're buying all these companies, buying banks, getting licenses, and none of it transfers over to the XRP token. So yeah, let's go ahead and pull up. There you go.
Yeah, so it's just, I don't understand how these 16 made it onto the list because when you look at the so-called metrics that they're using to determine detachment. So let's just take a look at these, right? You've got a Nakamoto coefficient, measures the minimum number of nodes required to compromise the network. So higher value provide low dependency on central parties. So how does that make sense when you talk about XRP, right? Isn't this completely centralized? So I don't understand how this could have a high Nakamoto coefficient. The Gini coefficient measures the concentration of token wealth. Lower values suggest a broader, more decentralized economic base. So we would have to go through and apply that Gini coefficient to each of these individually. That would be really interesting to do that and see what the results are. A geographic distribution, so measures physical validator dispersion across multiple jurisdictions. Would definitely have to go through and do that. And then you got this developer activity, which tracks protocol updates made by independent contributors, proving essential efforts are distributed. So who's building on Doge again? Who's building on Shiba Inu? Like, who's building on Bitcoin Cash and Litecoin? Like, how to make this make sense? This doesn't make sense. And then if you take a look down through the rest of the slide deck, so it's great that they're finally putting together some regulatory clarity for this. The thing that I take issue with is the list. It looks like those tokens that made it onto this list were simply the ones that were shilled the hardest by attorneys. That's kind of what it looks like, that lobbyists were able to get this list put together, because there's a lot on here that doesn't really make sense to me. Let's see here. Yeah, man, that is pretty wild. That is pretty wild. Now, I do have another piece of video content here, Mike, that we could watch around that crypto regulation, this new era of crypto regulation.
Well,
And I don't know about you.
we got about 8 minutes. I'm gonna drop off, and hopefully Don is gonna jump in for the next show, DeFi High, and I'm gonna make sure that he's set up. But I'll leave you to it.
Sure. Awesome.
And then if you could at the very end, if I'm not able to jump back, if you just want to quickly just kind of show people where to find us on YouTube, X, and the Node.pro.
Will do, man.
Awesome. Thank you, brother.
You got it. All righty. So let's take a look through crypto regulation. I think it's really important that we understand this. So I want to run through this piece of video.
Okay,
content.
let's dive into the massive shift in US crypto regulation that just happened. For over a decade, the crypto world has been kind of stuck in this confusing regulatory gray area. The old way was regulation by enforcement, total chaos for projects and investors. But on March 17th, 2026, the SEC and CFTC dropped a unified rulebook to finally end that chaos. It's a whole new 5-category system. The big idea? It's all about what an asset does. First up, digital commodities. Their value comes from the network's code and users, not a central team. Next, you've got digital collectibles. Think NFTs or even meme coins, things valued for art or culture. Then there are digital tools. They're basically like software keys, giving you access to something on a network. Fourth, we have payments stablecoins. They're for payments backed by real money and regulated like banks. And last, digital securities. These are just traditional things like stocks, but on a blockchain. So here it is, all laid out. You can see who regulates what and the key differences. But you know what the real game changer is? This thing they're calling the official list. Yep, they actually named names. These 16 big ones are now officially digital commodities. Huge news. And it's not just about these 16. It creates a clear path for other projects to graduate. They also introduced this really smart legal idea. They're calling it attach and detach. So an asset can start as a security for fundraising, then detach and become a commodity later. So we're moving from once a security, always a security, to something way more dynamic. Okay, so what happened next? Well, the markets reacted fast. Just look at this. Spot crypto ETFs pulled in a staggering $1.71 billion in just 3 days. And listen to this from Bitwise's CEO. He thinks over 100 new crypto ETFs could launch in 2026. You could say this clarity kicked off a golden age for digital assets in American finance. So the big question is, did the US just create the perfect framework for digital innovation to finally thrive?
Well, I certainly hope so. But I've got to learn more about how this is categorized. What is the attach detach framework? What exactly is that? I think that that's going to be really important for us to understand. And so, in the final handful of minutes that we've got here, I want to run through this slide deck. I just want to see if we can understand attach detach. Okay, so this Project Crypto release looks like ended the era of regulation by enforcement. So we've got this bipartisan harmonization between SEC Chair Paul Atkins and CFTC Chair Michael Selig. So they're creating this unified cross-agency standard. Okay, so the new standard effectively supersedes the outdated 2019 SEC framework, rejecting the overextension of the Howey test to decentralized technologies. Okay, that's a good thing. Actionable clarity. So it establishes a permanent functional taxonomy delineating exact jurisdictional boundaries for market participants. Okay, great. So they're putting all the rules of the road out there. And this is what they're saying. This is the regulation by enforcement. That was the dark ages. And now we've got objective architecture. So pre-2026, the so-called dark ages, we had this jurisdictional approach of turf wars and fragmented, inconsistent staff guidance from the SEC. And for asset classification, you had the binary application of the Howey test, security or not, and the protocol evolution. So they said that once a security, always a security. That's the important thing. This is apparently that attach detach now, where that can change. And back in the dark ages, we had capital sidelined by legal hazards, right? You didn't know what was legal, so no one could invest. And so that staff attention bulletin 121 restricted the ability of institutions to invest in digital assets. But now you've got this golden age, this new 2026 framework. You've got the harmony of the SEC and the CFTC working together. But it needs to become statutory. Right now, it's not. It's more policy. And that means that a new administration could reverse these changes quickly. So you've got this new modular 5-category functional taxonomy, and they're trying to base it on economic substance, I guess they say. And then they moved from the once a security, always a security protocol to now it's attach and detach. So assets can mature from securities into commodities. That's pretty interesting. And because SAB 121 was, made null and void, and you got the passage of the Genius Act, that means that there are now like a clear harbors for real big institutional money to buy these approved ETF products. So that's good. Here's that 5-category functional taxonomy. You've got digital commodities. The regulator there is the CFTC. So that would be Bitcoin. And then you've got digital collectibles. The regulator here is going to be the FTC or state law. So an example of that would be like NFT collections. And then you've got digital tools. So this is like the regulator would be federal software standards. And an example would be, those Ethereum domains, ENS domains, regulated as a digital tool. And then you've got payment stablecoins regulated by bank regulators. And an example would be USDC, Circle's product. And then you've got digital securities. So the regulator here is the SEC, and an example of that would be tokenized bonds. So that's pretty clear. Those 5 categories, pretty clear there. All right. And then the programmatic standard. So we've got 1 minute left. I think we've run out of time. I want to go ahead and just, thank everyone for joining live. I know that we had a lot of but I want to go ahead and just bring it on over here to the YouTube channel real quick, just so that you guys all know where to find us moving forward. So here's YouTube, the Node channel. It's at the Node channel. If you find value in what we do, just talking through digital asset markets and traditional finance news and running through some education, go ahead, subscribe over here at the Node channel. We're going to run DeFi High School with DeFi Don in just a couple of seconds here. So I'm going to go ahead and sign off. But the YouTube channel is the place to find us. You can also find us on X. And if I just hop on over here to X real quick, this is in my DeFi University account. But if I search for the Node, then I'll find the Node channel. Here it is, at the Node channel. And then the last place to find us is going to be our website here. So if we just go ahead and share X, here's the X channel, and that is at the Node channel. And the last one is the website, which is right here, thenode.pro. So I hope that this has been valuable for everyone. And Mike, if you want to take it away on over to the next stream.